Before I start, I kind of just want to ask the room any questions you guys may have about trading. Today is going to be a relatively short session because I'm under a gun. I have a meeting to go to, but I wanted to find out if you guys have any questions regarding your trading problems, your trading issues, what you guys have been trading. Just feel free to next 5 minutes. We'll just take some questions and then I'll get into it and I'll talk to you about some of the trades that I've been making and how we've been trading momentum in FX. So go ahead, post out anything you guys is on your mind. Nobody has any questions? Nobody has any ideas? Nobody's doing anything differently? No? That's a great question. Pacer is asking, do you avoid taking, Tom is asking, what is a pip? Pacer is asking, do I avoid taking momentum trades at a time like this past weekend, which is big news risk times? It's a great question, and it really is very much, the answer to that is very much yes. There's a distinction between momentum and volatility. And it's a very, very important distinction that I think takes a very long time to learn. And in many ways, I think it's a distinction between winning and losing. So what you want is the kind of nice, smooth moves like this, or nice, smooth moves like this, which are essentially momentum moves. What you don't want is these kind of wild spikes up and down, or wild spike reversals like you have here, which are volatility moves. And generally, what we always do, I think the best way for maybe to answer that question is to show you how we trade flow in BK, and I think that will answer how momentum is traded in BK. So the standard prototypical flow trade is something like this. We basically look for a move of 50 points from the 00 level to the 50 level. Let's say this would be a short trade. And then if we do get that kind of a momentum move, that means we have strength, in one direction. We're going to take this to the short side and target 33 points to the profit and put a stop right around here. Just to make this a lot more clear, I'm going to make this visual for you guys. So the stop would be, I'm going to change the colors here so you guys can see this. This would be the stop level, and the target level would be like at around right here. I'll make this green. So that's a crystal clear flow trade in terms of the actual money management, in terms of the risk structure of how we set it up. But what's very, very important to understand is that this isn't a trade that we do blindly. In other words, we just take any time the market action moves 50 points in one direction, we just get short behind it or get long behind it. There's always a fundamental component to this, which basically involves volatility and involves, the question, is this a reasonable trade or an unreasonable trade? Now, this morning, as you can see, this trade actually would have worked quite nicely. Obviously, the unwind was quite good. But look at the volatility that you had here. You had a big move and a big spike up and possibly a big reversal. And that's because the trade was not a one-way trade. The best ways that you want to trade flow is when there's preponderance of evidence that it's going to be a one-way trade. Here you had a tremendous amount of kind of two-way junction between the buyers who were enthusiastic about the Greek election coming about, and the sellers who were fading the move. And usually when you get this kind of price action, it's best to stand down. A couple of good examples of where we will pass on a trade, even if it does set up technically, is right after an ECB rate announcement, right after the Fed announcement, or right after the NFPs. In other words, when I'm watching very, very volatile fundamental trade events, I generally never trade right behind them. We certainly never trade right in front of them. In other words, we don't sit there and say, well, if it rises over here in front of the NFPs, we're going to get long into the NFPs and then hope to pray that it works out our way. We certainly never do that, but we also don't, for example, our rule is that we generally never trade the NFTs until at least 1 hour past the event. And the same thing with the ECB meeting, and the same thing with the FOMC meeting. And the reason why is because in the first hour of trade, there's a tremendous amount of jockeying back and forth between the buyers and the sellers. And you're just as vulnerable to just getting stopped out as you are to making money. And the whole point of all of these trades is not to be even money. The whole point of these trades is to be 65% or better. What you want to do with the flow trades, and this is what we try to accomplish consistently, is to win 2 out of 3 times. So in order to do that, you have to be very, very selective. And in order to be selective, you have to try to avoid, as much as reasonably possible, the volatility times and just take momentum when it looks like it's going to be a one-way trade. Now, when you look at the numbers, it's actually really interesting because if you think about this, we have 3 trades. One is a minus 50, and 2 of them are plus 33. So when you add up the numbers, it's only 16 pips on 3 trades, which sounds like, wow, that's so little pippage. You know, in the age and time when everybody promises you, I'm going to make 100 pips every single day for the rest of my life. But that is actually a very, very reasonable rate of return if you're any kind of a real professional trader. Because if you're talking about 16 pips every 3 trades, and let's say we take 150 trades a year, let's say we do 3 trades a week, which is pretty much what we do, times 16, which is basically, what does that work out to? Bear with me. 50 times 16, that works out to about 800 pips a year, or 8% unlevered, which is about as good a rate of return as you can possibly imagine, especially when it's what's called a low volatility return. When, if you can make 800 points at the end of the year and not draw down more than 400 points, in other words, if your total cumulative profits at the end of the year is twice the total biggest loss that you have at the end of the year, then you are obviously in pretty good position. If you can do that consistently, this is what, for example, Paul Tudor Jones, who's probably one of the greatest hedge fund managers in the world, preaches. If your run-up is twice as large as your drawdown, then you're a great trader. And that's kind of how you have to look at it. Now, you can then, lever your returns, unlever your returns, do whatever you want. But the whole idea here is, in my opinion, to have a very realistic understanding of what is it that you can accomplish given the market, given the market conditions, and given how prices really trade. Because I would love to be able to make 100 points every single day, which would basically, what is that, 250 days times 100 points? That's 25,000 pips a year. If I could make 25,000 pips a year, I'd be a billionaire very quickly. And of course, anybody who tells you that is lying. I don't know anybody who can make 25,000 pips a year consistently without having massive drawdowns as a result, and generally only on massive leverage. But 25,000 pips on leverage would be a wonderful ability to do, although absolutely, I think, impossible. So the key things that I sort of veered off the question, the key things about, I think, flow and momentum is that it's got to be differentiated from volatility. So the question that Pacer asked is a very good one, which is that given a choice between passing on a trade or taking a trade that looks problematic, and by problematic I mean that the volatility is too big because of the fundamental risks surrounding it. There's a lot of fundamental uncertainty about how the issue can be resolved in the marketplace. Then it's better to actually pass up on a trade than to take a trade, because the whole idea here is to take less trades but to be more accurate. In a perfect world, if you can trade flow at 70% accuracy, you're doing really, really well. But if you can just trade it at 65% accuracy, if you can win 2 trades for every 1 trade you lose over a long period of time, then obviously you are net positive, and that's really all that matters in the marketplace. So I hope that was a little bit of a convoluted, but I think an interesting answer to the question of how do you take momentum trades. Does anybody have any follow-up questions regarding that issue? The risk and reward ratio is actually negative, as you can see. In this particular case, the risk is 50 points, right? And the reward is only 33 points, which is like, I think it's, I don't even know, what is that? Like 33 divided by 50. That's like a 2/3 to 1 risk reward ratio. And why is the risk reward ratio negative? The reason why is because there's only two ways to trade in the market. You can trade what's called high probability trades. That is, you can win more than 50% of the time, or you can trade high profit trades. Now, high profit trades where you risk 1 point to make 2 points are almost never more than 30% accurate. If you can be 40% accurate, risking 2 points, or risking 1 point to make 2, then you're a great trader, and I wish you the best of luck. But I have never seen the market be so generous as to pay me $2 for every $1 of risk more than 30% of the time. So what we find generally is the exact opposite. What we find is that it actually makes more sense to trade higher risk, smaller reward, because you're going to be more accurate, and over the long run, the accuracy trumps the losses, and you actually become net positive, if that makes sense. Chris is asking me, do I still trade the RSI momentum strategy where the RSI closes below 30 or the RSI rises above 70 with a 30 target, 30 pips target and 50 pips stop? Great question, because let's take a look at the RSI strategy in detail over the last couple of days, and most specifically, so this is the pound dollar, right? And I'm just going to lay down the RSI on this. And we're going to make the color black here. Okay. So the reason why I think this is such a great question is because this is the pound dollar. Now, this strategy does not work nearly as well in the pound dollar as it does in the euro dollar. But I'm choosing the pound dollar just to show you that even despite all of the problems that the pound dollar faces us sometimes, the strategy is actually quite interesting. So let's just take a look at a couple of possibilities in the pound. Oops, sorry. In the pound dollar. So I'm going to pop this up. So this is right over here. The RSI is 63. On this particular candle, the RSI is 72. One of the interesting things, by the way, about this strategy and of course about the flow strategy is that I'm very, very interested in trading these strategies only during specific periods of time. During specific periods of time, meaning high liquidity time. So it's generally I'm trading them between the European Open and the European close, not the North American close, but the European close. So when Europe and North America intersect, and when Europe comes online, sort of crosses over from Asia, that's when I like to trade them. So the interesting thing about the momentum strategies is there are really actually three variables. There's the momentum variable, there's the volatility constraint, and there's the liquidity requirement. Right, and liquidity is a key point. So the hours that I trade this from are generally going to be from New York time, my New York time, between 3 and 4 a.m. till about 12 noon New York time on all of my flow strategies. So in this particular case, the 3 o'clock open, the candle goes up above 70. I'm long at 54.49. My stop is 5400. My target is 54.70. As you can see, the target is met on the next candle over here. Right, nice big pop. And now the strategy dips down below, and I think the next trade actually, does this trade? This trade goes above 70. You could take this one. This is a little more problematic. The other thing, by the way, the last constraint. So we have three constraints. We have momentum, volatility, liquidity, and the last constraint that I actually like to do is to not trade more than one time per day. But if you were going to take the second trade, in this particular day, it closes at 85. You're targeting 55.15, and it just barely misses. And you can see that this is the reason why I don't like to trade more than once a day. But so anyways, one trade positive, one trade negative. Here you have, let me see, here's sorry, this is the 72. You long at 55.19, targeting 55.50, and here, of course, it makes the trade on the next two candles over here, right? Here, you actually miss the trade. This is a trade where you're coming into a 30, you sell right into the spike. I actually got killed in this trade, and I missed the trade. So we have two positive trades and one negative trade, which is exactly what we want, right? We want two positive trades, one negative trade. It doesn't sound like a lot, but it does add up over time. And, of course, the really, really great RSI flow example was all the way on Friday when we got this massive squeeze, right? And the squeeze was really unbelievable. So here's a move. Let's see where the RSI goes to 70. RSI goes to 70 on this particular candle. And you close 56.32, and, of course, I think you make it probably 56.60. Next, like third or fourth candle into it, you make the 30 points on the first move, and then, of course, it continues all the way out. So really, really powerful move on the pound. So the key thing, somebody else is asking me, do I let the profits run, right? And it's a great question, and the answer is no. It's not because I don't think that's a good idea. It's just that I'm a single entry, single exit kind of a guy. Basically, my whole idea is I'm going to play a lot of hands against the market. I'm gonna make a lot of trades against the market, and I want to have a very, very controlled risk-reward parameters. My point is volume, right? If I can generate lots of different volume, and as long as that volume is 2-to-1 winning trades versus losing trades with proper risk rewards, I am net positive, and that's really what I'm looking forward to do. Now, the other way of trading, which is a very, very good way of trading, is when you get into a trade and it's positive, you can milk the rest of it. You got in here and positive, went to break even, you had like almost 150 points worth of profit on the second half of the trade. The reason why I don't like to do that is because those kind of moves are very rare. They're like 10% of the time you get this kind of a massive, massive move. And to me, the 10% of the time that's positive is not worth 90% of the time where I'm going to break even on the trade and lose half of my profits. So again, matter of probabilities. It's really all about numbers. What do you feel comfortable with? What do you feel confident in? And how do you want to construct your business as far as your trading methodology? There's other ways that the guys trade that I think is really interesting, which I certainly am unable to do, but is very, very powerful, which is the scaling up in a position. So you get long a position, and you're in the profit, and you actually add to the profit, and you continue pressing the trade if you believe that it has strong continuation. So sometimes this is a very interesting, again, not a very frequent occurrence, but sometimes this is what happens when you're buying above 70 and it works. In other words, the first breakout really works and you turn positive, and you add to the trade on the second candle, you can actually get further moves higher on the RSI flow. So there's a lot of different ways that you guys can trade this, and a lot of different ways that you can move it around. But the key thing here is to do what you're going to be comfortable with. Okay. So let's see what else somebody's asking me here. How do you choose RSI momentum, value, bungee jump, roller coaster? What factors am I looking at? The best way to do this is actually, in my opinion, and there really isn't a very, very good single answer, but what I would say is the best way to do this is through multiple accounts. I think it's very, very important not to pollute the account with different strategies, because what typically happens is some strategies are going to be working sometimes, other strategies are going to be working other times. If you have a winning strategy in an account and a losing strategy in the account, what you're going to do is you're going to abandon the losing strategy. And it's a very, very bad thing to abandon a losing strategy, in my opinion. The reason why is because every strategy is going to be a losing strategy. So if you abandon trading something just because you missed a couple of trades, what you're doing is you're completely destroying the whole underlying foundation of what you were supposed to set out to do, which is take multiple amount of trades, do lots and lots of sampling, and actually see how it works out, not over a day, not over a week, not over a month, not even over a quarter, but really over a full year's time. Until and unless you have 100, 150 trades in a particular strategy, you have no legitimate opinion on it. You have no reasonable opinion to determine whether it's profitable or not. So the best way I found, just from a psychological point of view, is to actually trade different strategies in different accounts. This way, you stay consistent. You're focusing on one strategy in one account, one strategy in another account. The other good thing about it, obviously, is that this helps to even out your overall equity curve, right? In the best case possible, case, every strategy is working and every account is making money, and that's kind of the, what I love to see. So the whole idea is to constantly look for the best strategies and only trade those strategies, but to trade them in separate accounts. I hope that that helps you out to understand of how I trade these ideas. As to what I think is the best versus worst in terms of my own personal rankings, well, the RSI momentum is a very good strategy. The BK flow is a very good strategy. There's another strategy which I don't want to tell you about right now that is better than all of them that I've been trading myself that I absolutely love. But one of these days I will reveal it to you. Sorry to tease you. But it does, honestly, it really doesn't matter because what you really want to do is, as long as you have a logical construct of what you're trying to do, as long as you begin to understand what is it that drives prices, how can you be as selective as possible, and how can you basically, the key thing is not how much money you can win. The key thing is how little money you can lose. The basic idea is how can you be as selective as possible in choosing your trades, then the pippage really begins to take care of itself. So those are the key things that I ask myself whenever I'm trying to construct a strategy and run a strategy into an account. Boyke, yes, I mean an account for each strategy, and I just explained why, which is that purely for psychological reasons, because if you don't have a separate account dedicated to a separate strategy, you will not take every single trade required by that strategy in that account. That's why I just sort of think that's why you should do it. So Pacer is asking me another question. He's saying sometimes the H1 RSI, the hourly RSI momentum catches nice long-term trends at the beginning. Do you consider any adjustments to keep forcing positions to ride a big trend? I don't, as I said, not because it's not a good idea, but because it's just not my personality. But I do think that this is something that maybe you want to, play around with. By the way, in addition to having these defined accounts that trade specific strategies, I, of course, as you guys well know, also have what I call an experimental account where I trade all of this crap, endlessly in very, very poor fashion in lots of different ways, and I try to, tweak all of these ideas. So one of the things that I would suggest to you, Pacer, is to try to press the RSI trade in one of your experimental accounts and see how well that works. See what currency pair this may work for. See how well the numbers are, because that's really the best way for you to gather data. I'm using standard RSIs. You can see this is a standard RSI setting at 14. I don't use anything outside. All of my indicator settings are based upon standard settings, and the reason why is because I'm not looking to be fancy, and I also believe in not optimization. In other words, if you can't make money with regular indicators, then you can't make money, because all you're doing is just optimizing the indicator for a particular timeline. These indicators, have regular timelines because the guys who produce them work really, really hard in getting the settings to be as normal as possible. So, I think I just pretty much honor the settings of most of the indicators that everybody sets, because I don't want to retrofit or curve fit any of my data. The experimental account is always live. It's just, like I have a $5,000 experimental account where I trade for $1 a pip, right? So, if I lose $50, I'll make $50. It doesn't matter. That's what I trade for. And my only function in that account, my only goal in that account is to stay even. Like, basically, my whole idea is to keep that $5,000 alive, because the function of that account is to learn, to experiment, to try to extract some, intelligent, interesting data from the market. Of course, you guys can create your own accounts. The good thing about the FX market is that we can trade micro lots, mini lots, whatever you consider, experimental for you. And then you can trade serious money with, larger lots and more mature and refined strategies. So, my personal accounts, I trade with 100,000 unit lots for $10 a pip in all my strategies. And I'll probably take it up. A lot of this stuff is working well, and I probably will take it up to larger denominations. It all depends on how you guys fashion your returns. I'm actually, by the way, curious. Like, what are the account sizes? If you don't mind it, what are your account sizes? You don't have to give me the exact numbers. And what is the size you trade against that account? Like, in other words, if your account is 5,000, just tell me the average ticket size. Is it a $100,000 lot? Is it a $10,000 lot? I wonder if you guys would be kind enough to post a few of these numbers, because I'm just curious to see. I'm just wondering what everybody does. So feel free to post your basic account size and your average ticket size if you can. Jay is so 3,000. Wait, so Jay, you have 10,000. You trade. Is that a point a pound? I guess pound base. I guess that's point a pound. And so $3,000 account. If you're risking 1% on 3,000, you're risking only 30 points, right? So that means if you're trading 10,000 units, you're only trading 30 points, which is a very tight stop minage. If you're trading less than 10,000 units, if you're trading micro lots, then that's pretty good. And so Pacer's trading 50,000 against standard lots. So you're trading 100,000. So you basically, Pacer's trading, this is really interesting. So he's got a $50,000 account, and he trades 100,000 lot size ticket. I'm assuming it's just 100,000, right? Because that means you're trading 2-to-1 risk reward, which is what I would consider to be a very professional and very proper risk construct. And I think 1% per account size is generally a good rule of thumb of how you want to trade. I think generally, basically, in my opinion, the highest risk per trade that you can do. I mean, this is kind of like where you have to be willing to lose 60% of your account. If you have $10,000 and you say, I don't care if it goes down to $4,000, I'm willing to lose up to $6,000. Then you can risk 5% on your money. But generally, if you don't want to lose more than, if you're not willing to lose more than like 35% on your account, then 1% of the account size is pretty much accurate. Between 1 and 2% is a good trade size for the account. So is that correct, Pacer? Are you trading basically 1 to 2? So you're trading $10 points on a $50,000. Yeah, that's you're trading like a stock trader, actually. It's very, very tight. I guess that definitely controls your risk substantially. I mean, most of it. This is a good group of traders in this room, because one of I think the biggest mistakes that most retail traders make is that they just trade massively large leverage. It's so attractive to take $1,000 and trade 100,000 against it, but your chance of blowing out are not just inevitable, but they're guaranteed. You will only survive for so long before you blow up completely. Yeah, well, that's actually another really good question. So another thing that people always say to me, well, I trade 1% per account size, right? Which is good, but imagine I'm long pounds at 1%, I'm long euros at 1%, I'm long Aussies at 1%, and and I'm long CAD at 1%, right? You think you have diversification. You think you have 4 trades. You're only risking 1%, but in fact, you're risking 4% because it's basically the same trade. I remember one time a guy came to me and he said, "Look, this is in the days of the carry trade." And he's like, "Look how well diversified I am. I have all these different currency pairs in my account." and he was long pound yen, euro yen, Aussie yen, and I think even Swiss yen, and dollar yen. And I was, and I started to laugh. I'm like, dude, you're over leveraging your account like 10 to 1 on the exact same trade. And of course, he blew up horribly on the account. So the only thing I would caution you is that the 1% per account, great idea, but you want to make sure that you're not commingling it with like a lot of other trades. I mean, I actually think it's fine to trade 1% and have 3 currency pairs at the same time because it's a 3% risk. It's not going to kill you, and there is a modicum of diversification there. So maybe not every time you're going to lose money on all 3. You may actually win on 1 and lose money on 2, or win on 2, lose money on 1, depending on the overall risk flows. There is clearly discrepancies between risk currencies, but generally you kind of have to go with the assumption that you long 1, you long everything. So leverage that I use in my real accounts, as I said, actually in my so if you look at my garbage account, it's actually very low leverage, right? So I'm trading 10,000 units against 5,000. So sometimes I'll go 2 or 3 currency pairs. So effectively, I guess that would be like 6 times leverage, right? In my strategic accounts where I'm trading specific strategies, I never go above 6.5% leverage, 6.5 to 1 leverage. And again, that's a pretty high leverage, and that's because I'm willing to lose 50% of my account. I'm willing to psychologically have the thing go down against me substantially because I have a lot of confidence in the strategies that I'm doing. I understand that they're gonna draw down, and also it's capital that I'm more than comfortable losing at any given time. This is the other very important thing is that all of this stuff is stress capital, and if you can't imagine losing half of it and going on with your life, then you shouldn't be trading it. You should be only trading the amount where if you drop half of it, it's totally not, it's going to maybe make you buy a hamburger instead of a steak, but it's not going to change your life. That's the key thing of how you got to look at as numbers. Any other questions you guys have for me? What is everybody? I'm actually curious. What's everybody? Chris is asking a good question. Do I only concentrate on a very few currency pairs, and how many currency pairs do I monitor trade? Great question. I actually monitor, and I want to do more. It's funny. I do concentrate on very few. I look at euro, pound, Aussie, and yen. I mean, I literally look at just the 4 majors all day long because in many ways that's all I really want to do. But I do actually want to look at the euro yen and the pound yen crosses for some of my strategies because some of the strategies are so robust that they actually can absorb the crosses and do well in the crosses as well. So I probably will expand my point of view. But it's a great question because you cannot look at a lot of different things. You can be aware of it. I'm aware of where Caddy is trading. I'm aware where Kiwi is trading, but I don't look at it. You cannot be master. What is it, jack of all trades, master of none? That is exactly what I try to avoid. Remember, as retail traders, we have very small but very distinct advantages. Our number one advantage is that our size does not interrupt the market. So if we're trading 1 million, even if we're trading 2 to 3 million, we will not disrupt the market, and that means that we can get our prices executed both on our limits and our stops. That's a huge advantage against the much larger guys who, when they want to make a commitment to a trade, they're going to disrupt the market and disrupt prices against them, right? Number 2, we can selectively choose when we can go in and go out of the market, right? That's very, very important. But, and this is really, really critical, we cannot monitor 100 different trades like a hedge fund does. We cannot have an understanding of how lots of different trades work. And I think one of the biggest things that people make a mistake on is they'll find a technical strategy that works on one currency pair, and the immediate assumption is, hey, this works on everything. That's crap, because as a matter of fact, I guarantee you almost no strategy is going to work. Strategies that work on euro will almost never work on the yen. Same technical strategy. And the reason why is because there are completely different characteristics of the currency pairs. And in order to understand the characteristics of the currency pairs, you really need to watch them very, very carefully. So there are basically two types of strategies. There's momentum strategies and mean reversion strategies. And pairs like the dollar yen, which is right now in the period that we live in, which is the last 2 or 3 years, is essentially a mean reversion trade for most of the time, and is a low volatility trade, is not going to work on a highly direction-driven momentum type of trade that the euro dollar is. Or, for example, the pound is not going to work nearly as well as the euro dollar because the volatility in the pound is much higher. Remember, we talked about the difference between momentum and volatility. We want momentum, we don't want volatility, because volatility will stop us out. Momentum will take us to profit. And what will happen very often with the pound is that before it takes us to profit, it stops us out because of volatility. You need to understand these incredibly important distinctions between each currency pair before you apply a lot of strategies to them. So Manoj is asking, this is what I find confusing. Just how many people are there who have sufficient risk capital that can afford to lose it? Most people say they're doing well if you make 20% a year, so you need very large accounts to be worthwhile. It's a tough question to answer because there's two answers to it. You can have a small account and you can use relatively high leverage, but and if you're lucky, more than good. If you got to be a little bit good, but mostly you got to be lucky. Sometimes you can make it into a relatively big account, and then of course the first thing you need to do is if you triple your account or something, is to actually trade smaller. The single biggest mistake that everybody does is they'll get lucky. They'll take a small account to a large account, and then the first thing they do is actually trade larger. And the moment they trade larger is when they blow up and give everything back. So yes, the answer is that you cannot get rich overnight. But the key thing is, if you're continuously doing this well, right, the account naturally grows. And if the account naturally grows, and if you're trading FX, which is a non-correlated asset class, that means it's an asset class that is an absolute return. There is no bull or bear markets in FX. It's always a bull market if you're on the right side, and it's always a bear market if you're on the wrong side, meaning that in equities we can have 2, 3, 4 years of just absolutely no returns whatsoever because the broad stock market isn't taking the stocks up. But in currencies, if you're trading well and you're making positive returns over a year, you can compound your account quite well. So to answer your question, first and foremost, Forex should be fun, and secondly, it should be a long-term endeavor. You got to be looking at this in terms of decades, rather than days, which I think is another big thing of what the guys who are successful are the ones that look at this on a decade-long basis as an interesting journey, and as well as the potential to supplement your net worth versus guys who are just trying to hit the lottery. We all know what happens to anybody who tries to hit the lottery. I trade primarily on 1-hour charts. Somebody's asking, is it possible to live from trading, or do you need to sell books, make a website, sell alerts, get additional income? No offense taken. If you have it's always possible to live from trading, I think, if you trade exclusively. And it's a very, very difficult proposition. Just like everything else, only 5 or 10% of people can do that effectively. I think, and this is one of the things that I think I differ from a lot of people who teach trading. I don't try to set false expectations. I try to create best practices. And the best practice conditions, the first assumption that you need to make is that you can't live on trading when you're trying to learn it. Generally, the rule of thumb is that it takes 3 years to get good enough that you can generate enough income to live off it. Some people may tell you differently, but I just believe in being honest and doing best practices ideas. Len is asking me, do I rely on correlation and non-correlated pairs to confirm straight the weakness of a pair you plan to trade? No. A correlation is the single biggest trap in the world. By the time it happens, it's too late. And by the time it happens, it's usually going to go the other way. So I don't try to guess what one thing is going to do relative to the other thing. Sometimes, it's going to confirm, sometimes it's not going to confirm. What you really need to do to understand is what is driving this particular pair. What was making this move in the pound on Friday? And the move in the pound on Friday was driven by two things, which was the liquidity that the Bank of England announced that we're going to do, which was viewed positive. But really the biggest reason why it was being driven was because there was fear ahead of the Greek election that maybe Caesar was going to win and there was going to be a possible fracture of the Eurozone. If there's a fracture of the Eurozone, well, what's the next best currency that you want to put your money into? You can't put money into Swiss francs because the Swiss franc is controlled, manipulated by the SNB. So the only free-floating currency in Europe that you can put as a safe harbor was the pound, and the pound had a massive amount of safe harbor flows out of it. So, with correlation, I predicted that? Absolutely not. So I'm not a believer in correlation as anything but a back mirror, as a great explanation of the past, which is nice, but I get paid on trying to figure out where the future goes. So Manas is asking me, what sort of results over what sort of time period do I need to take to an institution if I want to be considered for a role as a trader? Honestly, if you do 20% a year for 2 or 3 years, you're a super good trader, and you probably could get a chance. The thing about institutions, though, and this is why I think people get very, very confused. Institutional traders, for the most part, are much worse than retail traders. The difference between them is that they just have a huge amount of money. Institutional traders basically just buy until they get profitable, or sell until it finally breaks against them. And that's why you see they occasionally, like the London Whale, will just simply get into such massive losses that they'll almost take the institution down. There are very, very few institutional traders that have good risk control and can actually take losses. Most institutional traders are just idiots who never take losses, just use the house's money until they get mildly profitable and just try to be lucky than good. So I wouldn't be so agile over the institutional traders because I've met more than a few of them, and I've seen more than a few of them, and trust me, they're nothing special. So yeah, 20% unlevered is super good, Tom. Yes, 20% unlevered would be really good. Yeah. All right, guys. So who has any more questions? I'm going to have to cut the discussion today a little bit short, although I think we actually covered some really, really good questions. We didn't do too much on strategies, although we obviously talked about the RSI momentum, which is, as I said, the two strategies that I love, that are bread and butter for me, that I trade in my real accounts, not just my real experimental accounts, are the flow and the RSI, the RSI bungee jump. And both of those, if you're selective and very, very rigorous in your discipline, work very well. So, nothing else. I know I'm actually curious, by the way. Let's end this by asking, who trades flow or RSI bungee jump here, and how have you done? Over the last couple of weeks on it? Okay. So Tom has actually said he's done well. I'm just curious, what have you traded more, Tom? Have you traded RSI bungee jump? And if so, what particular pairs? I'm curious if you guys can be a little more specific for everybody in the room. What strategy, if you can just post, what strategy, what pairs, and how well it's done for you, if you guys really want to disclose that. Jay's been doing RSI, and he really likes that strategy too. So yeah, Manos clearly not a momentum fan. Well, I'm glad you're in enemy territory here. I'm sure it's always good to learn what the opposite side is doing to expand your mindset. But I understand it. I understand why it's just if it's your mindset, you certainly don't want change your mindset. It's very, very important to trade with your behavioral characteristics, not against them. So Tom is interesting enough. You've been trading cable on the RSI. That's really interesting because that's a very highly volatile trade, but it's been very favorable lately, and it's been really working well. So that's kind of cool. Jay, what have you been trading? Which euro are on the RSI, cable, any other currency pairs? Oh, this is really interesting. See, unfortunately, I'm an American, so of course I'm barred from trading gold right now. But that's really interesting. So Jay's been trading gold on RSI. One of the things that I want to do, and now that I'm a free man, is actually look at a lot of other instruments away from FX, especially certainly on the equity side, because I used to trade equities all the time, and I just have completely gone away from that. I haven't traded equities in a decade, but I'm convinced that a huge amount of these intraday pricing strategies that I've been trading could be applicable to equities, to crude. So that's really interesting. I'm really glad that you guys are working on the other instruments because that's something that as a to-do list for me, but I just never get a chance to try it out. But now that I'm a free man, maybe I'll get a chance to do it. So Tom also puts a discretional overlay, and he needs the fundies at his back, which is really great. I pretty much have taught you everything you need to know. I don't even know why you're in the room anymore because you probably trade better than me at this point. So go ahead and take a bow. So that's really good. But I think, that's really the key thing here. What Tom said is probably the single most important takeaway from all of this. The strategies that I give you are just basically logical overlays, but they're not mindless robotic trades, because if you turn them into mindless robotic trades, you're guaranteed to lose. The difference between winning and losing is discretion. The difference between winning and losing is actually not taking the trades that are not perfect. The hardest thing in trading is not trading. The hardest thing in trading is actually not winning but not losing. That's why we have our experimental accounts, right? That's why I constantly butcher my experimental accounts. If I'm going to destroy money, I'd rather do it on a small amount of basis where I really don't care. And I stay away from my, and I keep my real accounts very, very disciplined. And I think that's the key thing. Len, I was actually testing yen crosses on a lot of the stuff. They've really been working well. The yen crosses have been tremendously trending and very good momentum examples as well. So I will be looking at yen crosses as another complement to all my instruments. Anyways, much as I love to talk more, I'm under a gun, guys. I gotta get out of here by noon. I want to thank you very much for coming into the room, sharing a lot of your ideas with me. Those of you who are late, I'll be here next month, and the only advice I can give you is GY, don't miss the seminar. But actually, the good thing is the admin is going to record the whole thing. You guys can watch it. I'll post it on my Twitter feed. Anybody, by the way, who does not know my Twitter feed and who doesn't follow me, this is a must for everybody. FX Flow. The best way to get a hold of me, the best way to see what I'm thinking, and the best way to kind of understand where I think the market tone and the market direction is going to go. So sign up on FX Flow if you haven't followed me, and I'll post the link tomorrow. So for those of you who missed it and try to understand what we did on the momentum, that's the key thing. All right, guys, and have a great day. All the best to everybody trading. Looks like it's going to be a pretty great week. We got FOMC, we got G20. Hopefully we're going to get a lot of momentum with as little volatility as possible. I wish you guys the best of luck and the best of trading, and I'll see you guys next month. Sorry. Bye.